CNA938's. It's a Thursday's edition of Money Mind. In minutes from its latest meeting, members of the U.S. Federal Reserve admitted and expressed concern about inflation. This thing with inflation is not limited to the U.S., though. It is going to be felt, or it's already been felt very acutely in many parts of the world, including Asia.
While we may not be able to control prices going up, there are some things we can do to at least look after our savings, which typically you'd leave with the banks. It's important to allocate some cash in hand as well. Unfortunately, for the rest of your savings, if you leave it untouched without actively investing, it's likely that inflation will slowly eat away and chip away at its value. So how do you circumvent that and make your money work harder for you? Time to find out our options. David Fergusson joining us as Chief Executive Officer and co-founder at Hugo. Hugo is a wealth care app, an all-in-one digital account that helps consumers spend, save, and invest, starting with gold. All that glitters there. Now, David, thank you for joining us. Welcome to CNA938.
Thank you for having me.
Now, times are difficult as we know it, and we've never saved harder than ever, well, thanks to the pandemic, of course. What are some common misconceptions about saving money?
Oh, gosh, that's a big question.
Start with a big one.
The common misconceptions. It's something that you always have to take your own personal responsibility for. One can't abrogate responsibility to other people for this. The other sort of major I guess sort of misconception that we deal with is that this is something that one can deal with later. We have to deal with savings early and often. I mean, it's one of these things that the earlier you start, the easier your journey will be. And one of the key things that we stress with our customers and with the sort of people, well, anyone who'll listen, frankly, is that the earlier you start, the better life will be for you. More importantly, there's no sort of bottom limit to how little you can save. Anything helps. It's a little bit like, I should take this advice for myself, it's a little bit like losing weight. Any amount of exercise is good for you.
So the earlier you start, the better. What else should we be, correcting? Are there any other misconceptions that people would have?
Well, I mean, a lot of people are very frightened and daunted by the concept of savings, so they kind of put it off and ignore it, and that's obviously a massive mistake that people make. It's like any uncomfortable subject. It's very easy to put off, procrastinate, avoid discussion. That's exactly what we want to try and avoid. We want to try to embrace these difficulties, and learn that this stuff doesn't have to be hard. I mean, savings does not have to be a sort of daunting, grey, dark subject. It can be fun and it can be shared with others, because if this is a fear you have, or this is a problem that you have as an individual, I guarantee 9 out of 10 of your friends are feeling exactly the same way. What we tell people is, share your problems, share your solutions, more importantly, and by and large, we'll all get through this stuff together. There is a huge community basis to reducing the fears that people have in saving and frankly creating shared success in the same process.
Right. So that said, how should we, in your view, be approaching saving really hard-earned money, especially in these times?
Well, so one of the things, I mean, we've had some fascinating discussions with our customers in Singapore, and what is clear is that quite often, fund managers and banks and insurance companies spend their time telling consumers how wonderful their investment returns are. And what we say is, honestly, if you're a dentist and want to be a dentist, and if you're a taxi driver and want to be a taxi driver, then actually you shouldn't be shooting for the best performance in the market. You should be shooting for decent average returns over time, and you'll get them if you just average in into your sort of savings pools on an ongoing basis. And those are the sorts of things that will holds you in very good stead for the long term.
Well, when you say averaging, you got to clarify that for some of our listeners, because does leaving my money in the bank mean averaging in?
No, so I mean, leaving your money in the bank is just about the worst thing you can do, frankly, because the interest rates you get effectively give you a negative return, a negative real return on inflation at the moment. So let's say you earn 0.5% in the bank and inflation is 2%. Well, you've lost 1.5% each year. So you want to avoid that trick. And frankly, that's a major problem for us in Singapore. We leave too much money in the bank, not really earning for us. So that money has to go into the market. And the problem with the market, or different markets, whether it's bond markets, equity markets, property markets, is that they're volatile. And people get very worried about the volatility, and they shy away from markets as a result. So the key way of getting out of the risk of volatility and getting out of the risks of downdrafts is to buy steadily over time. If you buy $100 this month, $100 next month, $100 the month after that, and you continue that for 30 years, the reality of it is that you don't really care about whether markets go up or down dramatically over the course of 2 or 3 months, because you're getting the average over a very long time. And that's dollar averaging.
And like you say, time can be your friend as well if you know what to do with that time and what to do with your finances as well. We are also wanting to hear about 5 growth options you said earlier to share your solutions. So this is where we ask you, David, about these 5 growth options that we can take note of when it comes to what to do with our money.
So as in 5 investment types or 5 sort of individual actions?
5 investment types.
So we look at, frankly, we create or we will create in our app a permanent portfolio that allows you to sort of average out between asset classes. So the assets that we are dealing with are global equities, global government bonds, property, money market funds, which are short-term cash instruments, and commodities. And if you do a sort of a decent balance of all of those assets, then what you find is that over time, when one market's up, the other one tends to be sort of down, and when the other's up, the other's down, the other one tends to be up, and they sort of average each other out over time. But what you get is, again, a little bit like dollar averaging. You get the diversification, sort of portfolio management benefit of these multi-asset classes, and over the long term, you end up with a very stable return.
All right, so let's get down to some of those, because I know that you mentioned bonds, you mentioned there are stocks as well. In terms of balancing a portfolio, do you have any personal sort of preferences? So we tend to not to manage portfolios in a particularly active way. I'd say we more broadly as within my investment group. Right. But within our app, ultimately we won't manage asset allocation actively at all. Ultimately, we set a strategic allocation of 20% in each of those asset classes, and we hold them over the long term with tactical reallocation on an annual basis. And that way, you tend to get these averages over the major asset classes over time. So, please continue. So people who do actively manage their asset allocations, I mean, some of them are very, very talented. But our argument is that the average person, the man on the street, including me and most people, shouldn't spend our time agonizing over that type of activity. You know, it's a sort of wasted effort, and more importantly, wasted energy on the sort of worries that one creates as a result of it. Oh, okay. I'm interested to know as well your preference for gold. Why is gold part of your savings strategy? Can you tell us?
So one of the things that, everyone will have known that everyone will know that over the last 20 years we've been living in very odd monetary environment. Unless you've had your head buried in the sand for 20 years, you'll know that we've had negative real interest rates, we've had central banks printing money left, right and centre in order to initially to sort of forestall the impact of 9/11 and then more importantly forestall the impact of the global financial crisis and then frankly avoid any major recession since. And that printing of money is inherently inflationary. Now, one of the great benefits of gold is that it's a very, very sort of stable, long-term store of value. And God isn't making any more of it, frankly. Central banks are printing money left, right, and centre, but gold is a stable, rigid supply, and it tends to track the increase in money supply. So the inflation that's caused by money supply increases and the printing of money tends to be offset in the gold price, and you've seen that. So I'll just give this one last number for everyone to remember. 50 years ago, the United States of America, went off the Bretton Woods standard, which means they gave up using gold as a fundamental backing for its currency. At the time, gold was $35 an ounce. Now, they've printed money for 50 years now, and now gold is just under $1,800 an ounce. Now, that gold price, long-term gold price movement is exactly the sort of protection that people should be looking for over the long term when considering their long-term savings profile.
What are the fees involved on your platform for trading gold?
Well, at the moment, there aren't any. So we've got a bunch of introductory offers to people that basically say you can buy, store, and sell gold on our platform for nothing. But over the long term, when we start to actually get rid of these initial offers, it'll be 0.5% to buy, 0.5% to sell, and 0.5% to store, which is incredibly competitive. And that's one of the major innovations that we've got, is that we've worked out how to provide you physical gold, i.e. not an ETF, not a derivative, but physical gold through the app at a very, very low cost. And more importantly, it doesn't have to be a rich person's investment any longer, because whereas a bar of gold will cost you $60,000 and is really the entry point in the physical market, outside our app, you can buy less than 10 cents on our app, if you like, and you can just build out very slowly and into your gold position.
Well, David, apart from a traditional bank account, tell us more about other things we should look out for when choosing other investment platforms to use.
Well, others other than ours. Well, you shouldn't. You should only use ours.
We've got to give options.
We always look at the fee burden. I mean, one of the things that is very clear, across, it's not just in Singapore, but in other countries in Southeast Asia as well, that consumers have been hit by very, very extensive costs for far too long. Candidly, you haven't had the government intervention in this part of the world that you have had in the United States or Europe about cracking down on some of the fees. So if you ask most people, what are the costs that they're paying to their money manager, most people have no idea at all. And it's those costs that suck out some of the benefits that you get from long-term savings. So we talk about compounding returns, and if you compound returns over time, you'll do very, very well. So it's the key reason for starting earlier. But the negative, or the sort of flip side of the compounding return, is the fee burden. And that fee burden that you see, and it's very, very expensive across consumer products in Singapore and other parts of Southeast Asia.
Right. Thank you. Well, thanks for your time today, David.
Okay, well, thank you very much indeed.
Yes, David Fergusson is Chief Executive Officer and co-founder of Hugo. You've been listening to Money Mind.
Before making any decisions based on the information in our program, please